Yeah. Welcome back, guys. Very good evening to all of you. So, students, today our chapter is a new one. Chapter 12, Audit of Banks. So, it is a very important topic, not only academically, but practically also. You would be conducting a bank audit as part of your articleship later on. So you have to understand the theoretical framework of how bank audit is conducted, what are the finer points, what is the theoretical framework, what should be the audit approach to be followed in case of banks, what are the various rules, regulations, RBI norms regarding asset classification, etc. So, guys, this chapter is broadly divided into four main areas. One is structure of banking in India. What kind of banks are there in our country? What is the regulatory authority? What is the scope of its functions? Second part is audit approach. How should an auditor approach when he conducts audit of the bank? Okay. Third portion is advances, which is the main core area of the balance sheet of a bank. So it requires greater emphasis, greater strength. And there are certain residuary matters in the chapter like appointment of auditor relating to audit report. So today, guys, we would be discussing first thing structure of banking in India and advances, because there are students, you have to understand many new terms which you might not have read earlier anywhere. So first we will familiarize ourselves with those new terms which are used in relation to advances, and then we will consider what should be the approach of auditor regarding advances. Okay. So this is the broad framework which we are going to follow today. And guys, my advice to all of you would be, it is a very broad, it is a very deep topic, but you have to understand it from the point of view of what is included in your syllabus at the intermediate level. Okay. Because there is a guidance note of ICAI on audit of banks also, which is quite voluminous, but these things are beyond the scope of your study material at this stage. So we would be dealing with the elementary things which are part of your syllabus, and are being dealt with in your module. Okay. So students, can anybody of you tell me what is the nature of banking business? How does a bank operate? Can you tell me what is the business model of a bank? What is the source of income, and what are the main expenses? How does a bank earn profit? Have you any idea? What is the nature of banking business? All of you have gone to banks to deposit checks, to deposit money, to withdraw money. All of you are using ATMs, debit cards. But how does a bank operate its business model? What is the fundamental logic behind the business model of a bank? Any idea, guys? Please drop your mails. Any idea? No mails, guys. So students, you have to understand that a bank has got two functions. One is accepting deposits from the public, and another is lending money. Lending money to whom? Lending money to trade, to industry, to general public, to agriculture sector for meeting their requirements. So how does the business of a bank operate? The bank accepts money from public and pays interest on it at a low rate. Say when you go to a bank and make a fixed deposit with the bank is giving you, for example, a rate of interest of 4.5% or 5%. So the bank is paying to you interest of 5%. But when the bank is lending money to industry, to trade, to firms, to corporates, then it is making those advances at the rate of, say, 7%, 8%, 9%. So the bank is making profit from this interest spread. Okay, so the bank is making profit from this interest spread, from this difference of, say, 5% and 9%. Out of this 4%, bank is meeting its establishment costs, and it is all its running costs, staff salaries, and other administrative expenses. So broadly, this is the business model of bank. This is how the banking functions, and bank conducts its business and it makes profits. Okay, so you are fine with it? Have you understood what is the basic modus operandi of the business of a bank? So guys, now what is the peculiar nature of banking? Can you tell? Can you think of some points that why banking business is peculiar, is very peculiar? It is different from other business. Why it is so? Can you think over some points? Please let me know. Can you think over some points? Now, some points could be that bank business is conducted through many branches, say thousands of branches. In a country like India, there are thousands of branches spread across different geographical regions. Okay, this could be the one point. So at the overall bank level, we are concerned with a bank with thousands of branches. Second point is complexity of transaction. Handling of cash is also one of the peculiar points. Specialized to the banking industry. And another thing is reliance on extensive use of technology. You know, these days the whole banking industry is automated and all the transactions are being done on CBS platforms, core banking solutions, in real time. The transactions are happening on real time. You transfer money from one account to another and it gets credited or debited from your account on real time basis. You are themselves, you might be making IMPS, transfer of money through IMPS, or you might be making RTGS, NEFT. So these transactions are happening on a real time basis, and so this also is one of the point which gives peculiar nature to banking industry. Okay, so you can think over many such things. That is why a special approach to the audit of banks is necessary. That is why we are studying this chapter as a separate chapter. You can say why audit of banks? So this is the reason why audit of banks, because audit of banks involves specialized considerations and it is a specialized area, okay, which requires special understanding. So is that clear? Should we move further? Now we come to the structure of banking. Structure of banking in India. What kind of banks are there in India? How they are constituted? What are different types of banks? So we will be having a overview of all these things. So one kind of banks are commercial banks. Okay, so commercial banks are which are visible to you all over the place, like SBI, PNB, Bank of Baroda, HDFC. These are all examples of commercial banks. Why they are called commercial banks? Because they are engaged in commercial banking, in the business of accepting deposits from the public and lending money. Okay, so these are known as commercial banks. So these may be government controlled, these may be public sector banks, or these may be private sector banks. Okay, all of these are commercial banks because they are rendering commercial banking services. Okay, so it is a sort of functional classification. Next type is development banks. Now, what are development banks? Examples of development banks are like SIDBI, Small Industries Development Bank of India, or Exim Bank, Export Import Bank. Now, these banks are meant to meet developmental needs. They give long-term finances. Say they give term loans, long-term finances for creating new assets, which are repayable in longer period of time, say 5 years, 10 years, you can understand. And they generally do not accept from the public. They do not generally accept deposits from the public. Rather, they accept deposits from commercial banks. If commercial banks have surplus money, they are making deposits with development banks. So broadly, you can understand what is the difference between commercial banks and development banks. Now we come to another category of banks, which is regional rural banks. Regional rural banks, popularly called as RRBs. Regional rural banks. So what are regional rural banks? These are generally confined to one state, and these usually cater to the requirements of rural areas. So there is a separate act, RRB Act, Regional Rural Banks Act, under which these banks have been constituted, and central government, state government, and one main sponsoring bank has a stake in these banks. Like say in one state, SBI may be sponsoring some Grameen bank. Okay, say in Chhattisgarh, there is a sponsoring bank, and some stake is of state government and some stake is of central government, and that bank is confined to Chhattisgarh, or say in the state of Haryana or in the state of Punjab. Okay, like Sarv Grameen Haryana Bank, Sarv Haryana Grameen Bank, like in J&K, Ilakai Dehati Bank. So these kind of banks are there in every state. So you understand RRBs, regional rural banks. Now we come to fourth category of banks, which are cooperative banks. Now cooperative banks are also catering to the generally to the rural customers and agriculture sector, but the important difference is that they are registered as cooperative societies. What they are registered as corporate under the Cooperative Societies Act. Okay, so basically RRBs and cooperative banks both are catering to rural agriculture sector, but cooperative banks are registered under Cooperative Societies Act. And there are two another categories of banks, new kids on the block, which have come in the past few years. Those are payment banks and small finance banks. What are these? Payment banks and small finance banks. Now, what do these banks do? Now, example of payment banks is like Airtel Payment Bank or India Post Payment Bank. Now, the payment banks, guys, they can accept deposit only up to a certain limit. They cannot accept deposits from general public beyond a certain limit because due to their very nature, okay, and they cannot make advances. So the basic purpose of payment banks is greater financial inclusion so as to improve the banking habits of people. So like in case of payment banks, they can accept deposits in saving account or current account of maximum up to rupees 2 lakhs, and they cannot make advances. Okay, but however they can issue ATM cards and debit cards, etc., but they cannot lend. Okay, and small finance banks are they can lend, but only to unorganized and small industries. Okay, so you can understand broadly these things. These category of banks, first we have considered commercial banks, there are development banks, there are RRBs, regional rural banks, cooperative banks, payment banks, and small finance banks. Is that clear, guys? Is that clear? So now, as you know, in every industry, to supervise its activities, to regulate its activities, there may be some regulators. So who is the regulator in banking industry? Obviously it is Reserve Bank of India, it is RBI, which has got all the supervisory powers over banks, over all the banks in India. It can inspect any bank. Okay, it can order audit, and besides, RBI has got wide range of functions. You might have studied in your economics classes earlier also that RBI regulates currency, it issues currency, it is responsible for formation of monetary policy along with the central government. So RBI, Reserve Bank of India, is the regulator of banking sector. RBI is the regulator, Reserve Bank of India is the regulator of banking sector. You have to remember it clearly. Okay. And you have also to understand that in India, banking is usually The day-to-day banking is usually conducted at branches. Like we are accepting, we are making deposits with the branch of a bank. Say there is a branch of a public sector bank, so I am having account in that branch, so I am depositing all my checks in that branch, and money is being withdrawn from that branch. So the essential banking business is conducted at the branches. And besides branches, there are controlling authorities, there are regional offices, there are zonal offices, and there is head office. Now, what is the role of these controlling authorities? Now, head office lays overall policy for the bank, like what should be the credit policy of the bank, to which sector lending is to be done, what should be the structure of delegation of powers, like in one bank the authority for sanctioning loans might be different from other bank, so it might be delegated as per credit policy of the bank, as per level of delegation, and to which sectors bank is going to lend money. Okay, so this is all in the credit policy and in the delegation of powers manual. So head office of the bank lays the broad framework. It lays the broad framework in which the operations of banking operations are to be conducted, and below that are zonal offices and then regional offices. So branches are reporting to their regional offices, and reports of regional offices are consolidated at zonal offices. So one zonal office controls few regional office, and one regional office controls few branches. Okay, and head office is overall controlling authority. So this is how the banking functions, because you have to understand this, because unless you understand this, how you are going to approach the audit of a bank, unless you understand the peculiarities of banking operations, how you are going to plan your audit, how you are going to strategize your audit work. Okay, is that clear? Yes, I got many mails. So, and one more thing, guys, you have to understand, while we were doing peculiarities of banking, you also have to understand that a host of laws, regulations apply to the banking industry in our country. There are many acts which apply to the banks. Like the most important act is Banking Regulation Act. Banking Regulation Act 1949. Now this is the governing act for banks. Besides, we are not to go into the details of what is contained in Banking Regulation Act. You have just to understand and remember the names. I am telling you about Banking Regulation Act because this is the most important act, and the format of financial statements is also provided. Financial statements of banks is also provided under Banking Regulation Act 1949. Okay, and Companies Act 2013, it is also applicable to banks. and then there is Prevention of Money Laundering Act. Okay, so similarly to regional and rural banks, RRB Act applies, SARFAESI Act, through which banks can take repossession of the assets which have been mortgaged with them in case borrower fails to pay the money. So there are many acts which are applicable to banks, and this also leads to complexity. So therefore, the auditor has not only to keep into mind nature of banking operations, but he has also to take care of the finer points of various laws and regulations which are applicable to banking industry. Okay, guys. Why special consideration to audit of banks applies? Okay, so now we come to some terms which are associated with advances of banks. But before we understand those terms, I will give you a broad view of how the balance sheet of a bank looks like, so that when we discuss about advances or about the financial statements, you should know how does the balance sheet of a bank looks like. Now students, you have to remember that balance sheet of a bank is to be prepared in accordance with third schedule of Banking Regulation Act 1949. It is not the same Schedule 3 of Companies Act 2013. That format does not apply to banks. Banks' balance sheet is prepared in accordance with the third schedule to Banking Regulation Act 1949. And it consists of two parts. What are those two parts? It has Form A and Form B. Now Form B consists of balance sheet, and Form B consists of profit and loss. Okay. Form A consists of balance sheet. And Form B consists of profit and loss account. So is that clear? I am again repeating, that is very important, that balance sheet of a bank is prepared in accordance with third schedule of Banking Regulation Act 1949, and it consists of two parts, Form A, Form B. Form A consists of balance sheet, and Form B prescribes format of profit and loss account. Is that clear? Fair enough, guys? So now we will see what are the main heads of balance sheet of a bank very broadly, and then we will come to the terms associated with advances. Okay. So on the liability side, capital and liability sides in the balance sheet of bank, there is these broad heads: capital, reserve and surplus, deposits, borrowings, and other liabilities and provisions. Other liabilities and provisions. Is that clear? Capital, under the liability sides, capital and liabilities, there are these broad heads: capital, reserve and surplus, deposits, borrowings. Now deposits are what? What is accepted from the public, or what is being accepted from other banks. So these include savings account, current accounts, deposits in fixed deposits, okay, and borrowings. Borrowings is amounts borrowed by the bank, and other liabilities and provisions, expenses payable, provisions, income tax provisions, residuary head. So this is the main capital and liabilities. Now we come to the asset side. Now what is on the asset side? Now on the asset sides, there is cash and balance with RBI. Another is balance with banks and money at call and short notice. Third is investments. Investments made by bank in shares, in securities. Look, a bank is required under law to make certain percent of its deposits in certain specified instruments, in certain securities. So there is investment. Now fourth is advances. Now this is the main asset of the bank. This is the main asset of bank. We had studied earlier that bank is accepting deposits from the public, and it is lending money to the trade, to the industry, and also to the general public. So this is the main item of the assets of the bank. So out of the total assets of the bank, these constitute, advances constitute a substantial portion. That is why special emphasis is laid by the auditor in auditing advances of the bank, and that is why we will be reading about the audit of advances of a bank in greater detail. Okay, and there are, besides advances, there are fixed assets and other assets. Okay guys, so for a better view, I am also going to share with you balance sheet of a bank, balance sheet of a public sector bank, to enable you to understand how the balance sheet of a bank looks like practically. The things which we are discussing right now, are they present in the balance sheet of a bank practically? So let us have a look. So you are able to see the screen, guys? Now this is balance sheet of a bank, of a public sector bank. So what is written here? Capital and liabilities. Okay, this is the liability side. Capital and liabilities. And then there is, here it is capital. Okay, reserve and surplus, deposits, borrowings, other liabilities, which we have discussed right now. And on the asset sides, there what is there? Cash and balance with RBI. And then there is balances with bank and money at call and short notice. And there are investments, advances, fixed assets and other assets. So you can see that advances constitute a substantial portion of the total assets of a bank. Okay, because bank is earning income only from advances. We had discussed at the start, it is how a bank functions. It is the model, it is a business model on which a bank functions. Okay, is it clear, guys? So therefore we shall be studying about some important terms associated with advances. Some important terms associated with advances. Now, what are those important terms? These we are going to study. So, important terms associated with advances. Now, one term routinely associated with the advances is funded facility and non-funded facility. Those of you who are referring to module, we are at the point number 12. But I will advise you not to refer to your module at this stage. Just listen to what I am saying. Okay, because I will try to explain you the things in a layman terms so that you can understand the basic logic behind these terms. So funded facility and non-funded facility. Now, what is the difference between funded facility and non-funded facility? Guys, look, when a bank makes a loan and it transfers money to the account of the borrower or to somebody on behalf of the borrower, it is known as funded facility. Like, say, when a company takes a loan from a bank to purchase machinery, then the bank is transferring money directly to the supplier of machinery, and the amount is debited to the term loan account of the borrower. So this is a kind of funded facility. When you buy a car and take a loan from bank, so the money is being paid to the dealer by your bank. So it is again a kind of funded facility where there is actual flow of money. The bank has given money. Paisa bank ne diya. So it is known as funded facility. Is that clear? when you take education loan from bank and the bank pays for your education cost, it is also a funded facility. When somebody takes a housing loan from a bank, it is also a funded facility to meet the cost of housing, meet the cost of construction of house. It is also an example of funded facility. So you understand what is a funded facility. Now we come to another term, that is a non-funded facility. Now what is a non-funded facility? You would say how it can happen that bank grants a facility which is non-funded, where there is no transfer of funds. Yes, there are types of non-funded facilities like bank guarantees. Non-funded facilities. Like bank guarantees. Letters of credit. These are examples of bank guarantee. These are examples of non-funded facilities like bank guarantees. Now, what is a bank guarantee? Say, we will understand it with the help of an example. Say there is a company and it wants to import some machinery. It has imported some machinery from say China. Okay, so it has imported some machinery from China, and at the customs there is a scheme of Government of India that you can save the custom duty on the machinery if you give an undertaking that you would be able to export your goods in a certain number of years, which have been manufactured, which are going to be manufactured or processed with the help of that machinery. So how does the custom department ensure? How will the customs department ensure that the company would stand on its commitment, that the company would make good its commitment of exporting the goods? At that stage, it would be saving the customs duty by giving an undertaking. But can merely undertaking of the company be relied upon? No. The customs would be asking the company to furnish a bank guarantee. So the custom department would be asking the company to furnish a bank guarantee. So the bank would guarantee that in case of default by the company, the bank is responsible. So if the company fails to meet its commitment, then the custom department is free to invoke that bank guarantee. Okay, so it is also a kind of liability which might devolve upon the bank in future. So it is also these kind of facilities are known as non-funded facilities. These are also kind of credit facilities granted by banks, but which are non-funded. These do not involve flow of money at the present, but in the future liability may devolve upon the bank, and there might be outflow of money due to default by the party. So such kind of facilities are known as non-funded facilities. I have given you the example of bank guarantee. Okay, so you understand Have you understood? Now another thing is letter of credit. Letter of credit. Now what is letter of credit? So letter of credit, say guys, it is also a kind of document generally mostly used in foreign trade transactions. So say I am an exporter and I am exporting certain goods and I do not know the credentials of buyer to whom I am exporting the goods. I am not sure about his credit worthiness. So what would be the assurance that I would be exporting the goods to that buyer and I would be realizing payment from him? So I would ask, as an exporter, I would ask that buyer to send me an LC, to send me a letter of credit. Okay, to send me a letter of credit. So letter of credit is a document given by bank making a commitment that if the goods are dispatched in as per agreement, what has been detailed out in LC, these are in accordance with the terms of LC, then that bank would be responsible for making payment. Okay. Similarly, in case of import of goods, the foreign person, the foreign party, they would not be knowing about my credentials. Okay. So they would ask me to open a LC, in their favor. Okay. So when my bank opens a LC, then it is then the LC might devolve upon the bank in the near future. In the near future, there might be a outflow of funds. If I do not meet the commitment, if I do not pay up, then in future there might be a outflow of funds. Okay, so these are examples of letter. These are examples of letter of credit, and in turn, which are examples of non-funded facilities. Okay, guys. So you understand the difference between funded facility and non-funded facilities? Any queries? Yes, Anirudh is asking, do bank charges any money for non-funded facilities? Yes, Anirudh, bank charges for issuing non-funded facilities like bank guarantees. There are considerable amount of charges. Bank guarantees and LCs, banks are levying charges according to their service manuals. Okay, and for issuing bank guarantees and LCs, bank might also insist upon keeping a certain margin money in form of fixed deposits. Say, you understand, say if some liability devolves upon the bank at a future date, so bank wants to safeguard its own interest also. Besides levying service charges in the form of commission or charges, whatever you might say, the bank also keeps certain amount in fixed deposits also. Is that clear to you, Anirudh? So you are clear about funded facilities and non-funded facilities. Now in funded facilities, students, we are dealing with three types of funded facilities. In funded facilities, we are dealing with three types of terms. Now, what are those three types of terms? One term is term loan. Another term is cash credit, overdraft, and loans repayable on demand. These mean one and the same thing. These mean one and the same thing. And one is bills purchased and discounted. So is that clear? We are basically dealing with three terms under funded facilities. One is term loans, one is cash credit, overdraft and loans repayable on demand, and another is bill purchased and discounted. Now, what is the distinction between these three terms? What is the difference between these three terms? You have to be clear about the meaning of these three terms, because distinction in all these three terms is very important while dealing with the audit of banks. Okay. So what are term loans? Now, term loans are loans which are generally repayable after 36 months, more than 3 years. These are generally for the creation of asset. Like, say, a company wants to purchase a machinery. So the bank would grant a machinery term loan. Now the company wants to construct a new building for its plant. So the bank would grant a building term loan. Now it would be, say, repayable in 5 years, okay, or in 4 years or 7 years, whatever are the terms of sanction, okay, in installments, which might be monthly or quarterly, okay. So these are known as term loans. So when you buy a car from bank, when you take loan from bank for purchasing a vehicle, it is also a term loan. When some person goes to bank and gets sanctioned housing loan is in his favor for construction of a house, it is also an example of term loan. Okay, so it might be repayable in, say, 10 years, 15 years. So these are examples of term loans. Now we come to cash credit, overdraft loans, overdraft and loans repayable on demand. Now, what is the meaning of term loans repayable on demand, cash credit? Cash credit loans, cash credit limits are the most popular means of lending to trade, to industry, to business in India. Now these type of facility, which we in popular language call as CC limits, cash credit limits, CC limits, these are granted to meet working capital requirements of the business, to enable the business to carry on its daily functions, to make purchases, to give salaries, to incur expenses for wages. Okay, so all the things which form part of the working capital cycle. So such loans are known as cash credit loans or cash credit limits, which is the word used more popularly, or in some banks it is called as overdraft loans, OD limits, and loans repayable on demand. It means that these loans are repayable on demand whenever there is no fixed repayment schedule. Whenever bank says these loans will be repaid. Now I will give you an example how a CC account operates. Okay, how a CC account operates. Say there is a company XYZ Private Limited. Okay. it gets sanctioned from bank, from branch of a bank, a cash credit limit of rupees 1 crore in its favor. Now, how the account is going to be operated? Now, at the first stage, the bank would allow the borrower to draw money up to rupees 1 crore. Say the company is a manufacturing company and obviously it would be needing raw material. So it would be purchasing raw material and issuing checks to suppliers. Say it has issued checks of rupees 50 lakhs to suppliers. So the balance in the bank would be 50 lakhs debit. Okay, because it would appear as an advance in the books of the balance sheet, and the same would appear as a liability in the balance sheet of the company. Say after few days, again the company has paid wages of rupees 5 lakhs through banking system. So the balance would be debit 55 lakhs. The company has sold the goods, and then after say 20-25 days, payment from the debtor comes, and the amount, say payment of 10 lakh rupees come, then this loan amount would get reduced by 10 lakhs. So balance would be 45 lakhs. So the say balance remains 45 lakhs for certain number of days, then interest would be charged only on 45 lakhs. So the benefit of CCA account is that interest is charged only on that amount which is used by the business, which is used by the company. Although the company is having cash credit limit of rupees 1 crore in its favor, but interest would be charged on the amount which has been drawn by the company. And it is a sort of running account. Daily there are transactions of debit, credit. The amount which is debited by the bank, it is being liquidated from the sale proceeds of the sale proceeds being realized by the company. Okay, so all the sale proceeds are routed through CCA account. Again, when the balance goes down, the company wants to make further purchases, then it can again use the limit up to rupees 1 crore. So this is how a cash credit account operates practically. Okay, it is a running account and interest is debited monthly on the balance, or keeping in view the balance which has been used by the company, by the party. Okay, so is that clear? What is CC account? Cash credit account. Yes, Jaspreet, I am getting your mails. Do not worry. So we have understood term loans, we have understood cash credit loans, cash credit limits, OD limits. These are same thing. In some banks, these are called cash credit. In some banks, these are called overdraft, and loans repayable on demand. These also fall under the same category. Now, third type of funded facility is bills purchased and discounted. Guys, are you able to understand? Because it is a relatively new topic. I hope that you are not getting bored. So it is a new topic. That is why I have thought it not to not to follow the module, but to make you first understand the concepts from a simpler layman point of view. Generally, basic fundamentals. Okay. So bills purchased and discounted. Now, what is bills purchased and discounted? How this is a funded facility, you would say? What is the meaning of this term, bill purchased and discounted? Say, we will try to understand it with the help of an example. Say, students, I am an exporter, and I am engaged in exporting, say, t-shirts to certain foreign buyers in USA. So I have made the shipment, and I have got all the documents with me which show that goods have been exported. I have got shipping bill, bill of lading, invoice, and then my payment terms with that buyer are, say, 90 days. The payment would come after 90 days. Then, but I want money just right now after I have exported the goods, because I cannot wait for 90 days. So what I would do, I would submit all these documents along with bills of exchange to my bank. And I would say I have exported these much goods, and these are the export documents. So bank would purchase these documents. So the bills would be purchased or discounted by the bank. Bank would charge interest, charges their commission on it. They are charging interest on advance. So this type of facility is known as bill purchased and discounted. Bills purchased and discounted. Because again, what was the fundamental of a funded facility? There should be actual flow of money. So in this case, bank has purchased the bills and credited the amount to the borrower. So it is a funded facility. Okay. So this is an example of foreign bill purchased. Similar transaction can also happen within the country. So these kind of facilities are known as inland bill purchased. Okay. But both kinds of facilities are funded facilities, be it foreign bill purchased or inland bill purchased. Both kinds of facilities are funded facilities falling under the head bills purchased and discounted. So I think you are clear about what we mean by term loan, what we mean by cash credit and overdraft accounts, and what we mean by bills purchased and discounted. Is that clear to you guys? Is that clear? Bills purchased and discounted. Now we come to another term. That is drawing power. Drawing power or DP. Drawing power or DP. Now this term is generally used in connection with cash credit or working capital loans. This term is generally used in respect of, is associated with cash credit accounts, cash credit loans, overdraft loans. Now, what is drawing power? Now, this we shall also understand with the help of an example. Say in the previous example which we had done, the company had got sanction limit of rupees how much? 1 crore in its favor. Sanction limit cash credit rupees 1 crore. Now this 1 crore limit the bank has sanctioned against stocks. Against stocks. Because it is for purchasing stocks and making realization from those stocks by selling those stocks. Okay. So sanction limit of rupees 1 crore is against stocks. So one of the conditions in sanction letter is that buyer has to keep a margin of 25%. Now what is the margin? What is the meaning of margin? Margin means the company's own investment. Say if the company is buying stocks of 2 crores, then 25% has to come from the company, and the balance would be financed by the bank. Okay. So drawing power means value of primary security less margin. Drawing power means value of primary security less margin. Less margin. Now you would say a new term has come, primary security. इसका क्या मतलब है? What is the meaning of primary security? So first we will discuss what is a primary security and what is a collateral security. Now when you take a loan from bank against something, that something against which you are taking loan is the primary security. Say if I am taking loan from bank again for purchase of a car, then car is primary security. Say if the company is taking loan from bank for purchase of machinery, then machinery is the primary security. Say the company is taking loan from bank for financing its stocks, it has got cash credit limit sanctioned in its favor for purchasing stocks for meeting its working capital requirements, then stocks are the primary security. So you understand what is primary security. Now there is another term, collateral security. Collateral means in addition to. Now what is collateral security? Say the company has purchased machinery by taking a term loan from bank. Okay. But here the primary security would be machinery, but the bank is not satisfied with just security of that machinery. It wants certain additional comfort. It wants some more comfort. So it would say you also keep property papers of some other asset, say of some house or some other land. Okay. So that kind of security is known as collateral security, which provides additional cushion to the bank, which provides additional comfort to the bank, so that if the borrower does not repay, so the bank would be in a position to sell that collateral security, to realize its money by selling that collateral security which has been mortgaged with the bank. So you understand the difference between primary security and collateral security. Clear? Now we were discussing what does DP means. Now DP means value of primary security less margin. Now say guys, when bank sanctions cash credit limits to companies, to concerns, to business, they generally insist that those companies, those business, those firms, they would be submitting stock statements. They would be submitting stock statements to banks at stipulated periods, say monthly or quarterly, whatever may be written in the sanction letter, whatever may be stipulated in the sanction letter. So the companies which are availing cash credit facilities, they are submitting stock statements to banks, either monthly or quarterly or at stipulated intervals, whatever has been prescribed in their respective sanction letters. Okay. So how DP is going to be arrived at? DP would be arrived at value of primary security, that is what is primary security in case of CC account? It is stocks. Say the CC limit has been sanctioned against the primary security of stock. So what would be the value of primary security? Say the borrower is giving monthly stock statement of 1.50, say 1.25 crores. Say 1.25 crores. $1.25 crores. And say there is a margin stipulated in the sanction letter. The sanction letter states that margin as per terms of sanction is 25%. Less margin 25%. Okay, so this is the margin. Whatever comes is the margin, and balance amount is drawing power. This means that the concern can use this facility only up to this drawing power. Okay. So is that clear? Say so what would be drawing power here? Say it comes to 30 lakhs. So what would be the drawing power? Drawing power would be 95 lakhs. So although the sanction limit in this case is 1 crore, but the borrower is submitting stock statement of 1.25 crore, then after reducing margin, drawing power would be 0.95 crore or 95 lakhs. So the borrower would be able to use his limit only up to 95 lakhs, not up to 1 crore. Again, say after 2-3 months, he is giving stock statement of higher amount, say 1.50 crore, then he would be able to fully utilize his limit. So you understand what is the meaning of drawing power. This drawing power is calculated monthly or at the stipulated intervals and is fed into the computer system. Okay, to mark up to what extent the borrower company, the borrower concern can use the limit. So this is an important concept in relation to cash credit accounts, in relation to overdraft accounts. So you understand the meaning of drawing power. Drawing power means to the extent the borrower can draw his money broadly. It is the it is a limit, it is the extent to which borrower can draw the money from bank, from the banking system. Is that clear? Yes. Okay. So we have understood drawing power also. Now we come to another important concepts relating to advances. What is that? That is very important, guys. And all of you must have heard somewhere in TV news or while reading newspapers. It is the concept of NPAs. NPAs, non-performing assets. Now, what is an NPA? Non-performing asset. So look, when bank lends money to some borrower, it gives the money on the premise that borrower would be regular in repaying its money and it would regularly service interest portion and would be regularly paying installments in case of term loan, or in case of cash credit account, the account would operate within the sanction limit, within the drawing power, or in case of say bills purchased and discounted, the amounts could be realized on due dates before these bills purchased and discounted become due, or before these become overdue. So what is a non-performing asset? So advances always generate income for a bank. So if some loan account stops to generate income for a bank, if it ceases to generate income for a bank, so it becomes a non-performing asset. It is called as NPA. It is called a non-performing asset. So the loan accounts which are generating income for the bank, these are called as performing assets, and those accounts which are not generating income for the bank, these are called non-performing assets. So this much clear, guys. Now why this distinction between performing assets and non-performing assets, that is NPAs, is important. It is important because as per RBI guidelines, as per RBI circuit, but when the account becomes NPA, the bank cannot realize the bank cannot book the interest income in its books of accounts. It has also to reverse any unrealized income. Besides, it has to make certain provisions for non-performing assets in its books of accounts as per RBI Master Circular. Okay, so that is why distinction between performing assets and non-performing assets. Performing assets and NPAs becomes very, very important area while auditing advances of a bank. Okay, so is that clear to you guys? Three terms associated with non-performing assets are asset classification, income recognition, and provisioning norms. So we would understand what is the meaning of this. Asset classification, as we have already discussed, is that assets have to be classified in accordance with the prudential norms into performing assets and non-performing assets. Income recognition states that income in respect of non-performing assets is to be recognized on the basis of actual record of recovery. Okay, it is not to be booked on accrual basis. If the account turns NPA, then the income would be realized only on the basis of actual record of recovery. Whatever recovery is coming, only that would be recognized as income. Okay. And there are provisioning norms. Provisioning norm means when the assets are classified as non-performing assets, then certain provision is required to be made in the books of accounts of the bank to take care of the fact that banks' interest would be jeopardized, because banks would not be able to realize some of their money. There would be a possibility that banks' profits might take a hit because banks would not be able to realize their money because the account has turned non-performing. So there are elaborate guidelines as given in Master Circular of RBI on asset classification, income recognition, and provisioning norms. Okay, so we would be discussing all the things in very brief, keeping in view contents of your syllabus. It is a very, very broad, long topic, but keeping in view contents of your syllabus, we have to discuss only those things. Okay. So guys, you have to understand that performing assets, which you can say are good accounts which are generating income from bank, the party is paying installments in time, interest is being paid on time, there are no overdues. These are such accounts. Okay, these are called standard assets also. Standard. These are called standard assets. Okay. These are called standard assets. So within standard assets also there are categories. One is standard regular, and another is SMA. Now standard regular accounts are which are completely okay. Installments in time, interest on time, account within the sanction limit, account within the drawing power. And what are SMA accounts? SMA means special mention accounts. Another term, special mention accounts. Now special mention accounts are those accounts which are showing some signs of stress, but which have still not been declared as NPA as per RBI norms. So special mention accounts also, there are three categories: SMA 0, SMA 1 and SMA 2. Okay, so SMA 0 accounts are accounts which are showing some signs of stress, like say checks of party getting bounced, okay, or the account remains overdrawn for 3-4 days beyond the sanction limit, and then it comes within the drawing power. Okay, or the installments are, although these are being paid, but say there is a, say the installment falls due on the 10th of a month, so the party is sometimes paying on 25th of a month or on 20th of a month. Okay, so these are SMA 0 accounts, which are special mention accounts showing some little signs of stress, which gives a hint to the bank that there is some problem with the party, that there is some, there is going to be some problem with the borrower. And SMA 1 category and SMA 2 category, if there are overdues between 31 to 60 days and SMA 2 60 to 90 days, say the installment has become due, the installment was to be paid by 10th of a month, but it was not paid even after 1 month, more than 30 days has passed, so between 31 to 60 days, it would be SMA 1, and between 62 and 90 days, it would be SMA 2. But even all these categories, these are still performing. These are still performing. These are still standard assets. You understand? We have still not come to NPA. What is the, what are the norms of NPA? That we will be discussing just right now. For timing, you can understand that standard assets consist of two subcategories, standard regular and SMA. SMA accounts are special mention accounts, again broken into three parts: SMA 0, SMA 1 and SMA 2. SMA 0 means accounts showing some signs of stress. SMA 1 means having overdues between 31 to 60 days, and SMA 2 means having overdues between 61 to 90 days. Okay, so is that clear? Now we come to, these are all performing assets, standard assets, good assets, still good assets up to 90 days. If there are overdues up to 90 days, these are still good assets, because as per RBI norms, these are still generating income from bank. Say there is an overdue of installment of for 1 month or for 2 months, but as per RBI norms, it is okay. The account is still generating income. It has not still become non-performing. But after 90 days, it becomes non-performing asset. What does it become? It becomes a non-performing asset. It becomes a NPA. It becomes a non-performing asset account. Okay, and provisioning norms apply. So what are the types of NPAs? So what are the types of NPAs? What are the types of non-performing assets? There are 4 types. One is substandard asset. One is doubtful asset. Another is loss asset. Sorry, 3 types: SSA, substandard asset, doubtful asset, and loss asset. Substandard asset, doubtful asset, and loss asset. Doubtful asset is again classified as D1, D2, D3. These we will be discussing right now. So you understand types of NPA: substandard, doubtful, and loss. Now, what is a substandard asset? First of all, you have to understand what is a substandard asset. So when an account, a loan account, ceases to generate income for a bank, then it becomes a non-performing asset. This we have read. Now, what are the norms when an account becomes non-performing, and when it ceases to generate income for a bank, there are separate guidelines of RBI in this respect. But whenever an account becomes NPA, first of all, it becomes substandard asset for first 12 months. For first 12 months, it remains a substandard asset. तो जो भी आरबीआई के नॉर्म्स हैं जिनको कि हम अभी पढ़ेंगे, बाद में कि वो नॉर्म्स क्या हैं, पहले 12 महीने, फर्स्ट 12 months, द एसेट वुड बी क्लासिफाइड एज सबस्टैंडर्ड एसेट इन द बुक्स ऑफ बैंक. ओके, सो आफ्टर सबस्टैंडर्ड कैटेगरी, after the asset has remained in the substandard asset category for 12 months, it becomes doubtful asset. It becomes a doubtful asset. Now for the first year, if it remains in the doubtful category for 1 year, then it is known as D1. Then 1 to 3 years, it is known as D2, and more than 3 years, it is known as D3. Up to 1 year, D1, 1 to 3 years, D2, and more than 3 years, D3. Okay. And what is a loss asset? Loss asset is one against which has been pointed out by internal auditors of the bank, or say external auditors of the bank, but the same has been not written off in the books of bank, against which say bank has no security. So it is total loss, total batta khata, the money is not going to come. Okay, so such kind of asset is loss asset. So is that clear? Different type of NPAs, substandard asset, doubtful asset, loss assets. You have to remember that whenever an account becomes NPA, for first 12 months, it would go to SSA category, substandard asset category. After that, it would move to doubtful asset category. And then if there is no security, there is another category of loss asset, if there is no chance of recovery. So under doubtful asset, there are 3 subcategories, D1, D2, and D3. In D1, doubtful assets up to 1 year. In D2, 1 to 3 years, and more than 3 years. If more than 3 years have passed under D3 category, then under doubtful category, then it becomes D3. So why this distinction is made? Because separate provisions have been prescribed by RBI for these different type of assets. In the master circular of RBI on asset classification and potential norms, separate provisions have been prescribed by RBI, which have to be made in its books of accounts for these different type of NPLs. That is why this distinction is important. That is why we are studying it. Okay, so is that clear to you guys? Is that clear? Now Pooja is saying we did all SP, NPA in advance account. Now it is easy to understand and provision problems. Pooja, where you have done, I am not able to understand. Either you have done in your accountancy class or where you have done. So whatever you have done, if it is adding to your knowledge, it's very good thing. So you are in a better position now to understand, because it is also giving you a theoretical foundation. It is also giving you a legal foundation. Okay. Now, what are the norms prescribed by RBI for considering an account as NPA? Or what are the norms prescribed by RBI for considering an account as NPA? Now, what are RBI norms? So RBI norms are separate for different type of advances. For different type of advances. Say in case of term loans. In case of term loan, the RBI norms state that if installment and or principal remains overdue for more than 90 days, say the installment, the company has taken machinery loan and installments are not coming, and installments remain overdue for more than 90 days. Okay, say monthly installments were stipulated in the sanction letter and more than 3 installments have become overdue. So this term loan would become NPA. Now what is overdue? Overdue means that the party is not paying on the due date. An amount becomes overdue when the borrower does not pay on due date. Overdue. Okay. If he pays on due date, it's okay. If he does not pay on due date, the amount becomes overdue. So if the amount becomes overdue for more than 90 days, then the term loan becomes non-performing. So it would go to substandard assets. First of all, for the first year, it would go to substandard asset. Okay. So normally, generally, the accounts do not straight away go to doubtful asset. There are some exceptions, but first of all, when an account becomes NPA, first it will go to substandard asset category, then it will go to doubtful, then it will go to D1, then it will go to D2 or D3. Okay, so this was the condition when a term loan becomes non-performing asset, becomes when installment or interest remains overdue for more than 90 days. Okay. And in case of bills purchased and discounted, what is the RBI norm in respect of this? Bill purchased and discounted. Now here also, if the bill purchased and discounted remains overdue for a period of more than 90 days, say the bill was to be paid on a certain days and more than 90 days have passed and the bill has not been realized, bill has not been paid, bill has remained overdue, so the account would become non-performing asset. Okay. So you have understood about the provisioning norm relating to term loan and bills purchased and discounted. Now we will come to the RBI norms relating to cash credit and overdraft loans. Okay. Yes. Jasprit Kaur, are you watching this auditing class or are you watching some other class? All, if you are a student of auditing class, yes, your queries are reaching. Tell me what is your query. I have already taken your name because in my mail box certain queries of some other class is also coming since last lecture due to some technical issue. So what is the norm relating to NPA norms relating to cash credit accounts? NPA norm relating to cash credit account. Cash credit account. Now here there are 3 conditions. What is the first condition? First condition is that the outstanding balance remains continuously in excess of sanctioned limit or drawing power as on for 90 days. Say the party, in the example we had taken, the party was sanctioned CC limit of 1 crore. Say its balance continuously remains in excess of sanction limit, that is rupees 1 crore for 90 days. Then the account would be treated as out of order. So a CC account becomes NPA when it becomes out of order, which is not in order, which is not working properly. So there are three conditions. One possibility is this, that you understand that CC account has to remain within the sanction limit or drawing power. The company cannot draw more than sanction limit or drawing power. Whichever is, either he can either draw maximum up to sanction limit. However, if the drawing power is lower than the sanction limit, then he can draw maximum up to drawing power, maximum up to DP. Okay, so if the account remains in excess of sanction limit or drawing power for 90 days. Now the word is continuous. Say the account has to remain continuously, the balance has to remain continuously more than 1 crore in this case for 90 days. More than 90 days. For more than 1 crore for 90 days. Say if the balance comes down even for a single day, then this condition will not apply. Okay. So in this case, the account will become out of order. Now second condition is, what is the second condition? The account is within the limit. Say the account is within the limit of 1 crore. Now you would say, then how the account would become out of order? Yes, there is a possibility that although account is within limit of say 1 crore, but there are no credits in the account. Say it means that account is not operated for 90 days. There are no sales realization, there are no credits in the account for 90 days, then also it becomes out of order. Then it also known as out of order. Okay. There are no credits in the account continuously for 90 days. The word here again is continuously. Okay. Or third condition is that account is within the sanction limit, but the credits are not sufficient to take care of the interest. Say some credits have come in the account, but the interest is more than those credits. It means that the party is not able to pay its interest fully. Okay, so in that case also the account becomes out of order. So when a CC account becomes out of order, it turns into non-performing asset, it turns NPA. So guys, we have understood when a term loan account becomes NPA, we have understood when a CC account becomes NPA, we have also understood when a bill purchased and discounted account becomes NPA. Okay. So in case of a term loan account, I am again repeating, in case of term loan account, it becomes NPA if the installment or the interest remains overdue for more than 90 days. In case of bill purchased and discounted, it becomes NPA if bill purchased or discounted remains overdue for more than 90 days. In case of cash credit overdraft account, it becomes NPA if it remains out of order. Now, when a CC account remains out of order, these are three conditions when a CC account remains out of order. Okay, guys. So you understand what are the RBI guidelines regarding non-performing assets. You have got a fair idea. And now we will also Now many of you are asking, sir, Pooja is asking, sir, break nahi hai kya aaj? Pooja, there is break, but requirements for NPA accounts. Now this also, students, you have to remember. Provisioning requirement for NPA accounts. Now there are different levels of provisions to be made for different type of non-performing assets. That is why distinction between these assets, distinction between substandard, distinction between doubtful, and within that D1, D2 and D3 and loss assets, it is important. Okay, so these different classifications are known as asset classification, and the provisions which we are going to study, these are called as provisioning norms. Okay, so in case of substandard assets, 15% of provision is required. 15% provision of the outstanding balance as on the balance sheet date. 15% provision is required. Say if some account has been identified as substandard assets and it is having balance of rupees 2 crore, then the bank would have to make a provision of 15% of the outstanding balance as on 31st March in the books of accounts, and the profits of the banks would be reduced, okay, by 30 lakhs. So you understand why this provisioning is important and why the auditor is concerned about finding NPAs from the books of accounts of banks. Because if the NPAs are not properly identified and proper provision is not made, then true profits of banks which are required to be stated as per RBI norms will not be stated. Okay. So is that clear to you guys, and you understand how important, how significant these things are? Okay. And in case of doubtful assets, in D1, D2 and D3. In D1, provision is made of, now the balance in an account may be secured or unsecured. Say if it is fully secured, it is fully backed by securities. Okay, it is fully backed by collateral securities. Then 25% of secured portion. And if there is some unsecured amount, then 100% of unsecured part. And in D2, it is 40% of secured portion and 100% of unsecured part. And in D3, 100% of secured portion plus 100% of unsecured part. Total provision has to be made. Okay. And in case of loss assets, you know, if there is no security, if the amount is not realizable, then whole outstanding balance, that provision has to be made at the rate of 100%. So remember, in case of substandard assets, provision is to be made at 15%. In case of D1, 25% of secured portion plus 100% of unsecured. In D2, 40%. And in D3, 100% of secured portion. And if there is some unsecured portion, then 100%. And in case of loss assets, 100%. Okay. So you by now understand that classification of NPA, how an amount would be classified, how an asset would be classified as NPA is based on the record of recovery. It is based on the record of recovery. Say if the account is not operating, the party is not making repayments of the installments, or it is not servicing interest, and its record of recovery is not as per the norms of RBI, then this factor only is important for classification of account into non-performing. Only this factor is relevant. Although the amount may be fully secured, although the although the borrower might have kept some amount as collateral security, although the loan would be fully secured, but that factor is not relevant for classifying an account as a non-performing asset. And classification of NPA is always based on the record of recovery. And one more important thing, guys, that is very important point. Do not remember it. Many times question can come on this point. It is very important. Classification of an account into NPA is always borrower wise and not facility wise. Not facility wise. What is the meaning of this? Say if a company has availed machinery term loan, okay, and it has also availed a cash credit account, and say the cash credit account is operating very good. It is within the sanction limit, it is within the drawing power, it is not out of order. But in the term loan account, the installments have become overdue for more than 90 days. Then you would say term loan account would be classified as NPA. But what about CC account? CC account was operating satisfactorily, but as per RBI norms, it would also be classified as NPA, because NPA classification is borrower wise, not facility wise. If one account, if one facility, one loan of a borrower becomes NPA, all loans become non-performing assets. All loans become non-performing assets. Say if some borrower has taken a housing loan and a car loan. Car loan is operating fine. The installments are coming. But in housing loan, the installments have become overdue for more than 90 days. Then not only housing loan would be categorized as non-performing asset, car loan would also be categorized as non-performing assets. This is as per RBI norms. So you have to understand that NPA classification is borrower wise, not facility wise. That is very, very important, guys. Remember. So at this stage, we are going to take a short break. So we'll be meeting after 5-7 minutes. Okay. Okay, guys. So break at this stage. Jaram. Yes, welcome back, students. So, there are some special considerations in accounts regularized near the balance sheet date. Say, now this is important from the point of view of an auditor. Now, say the account was not performing well, it was on the verge of becoming NPA, but as at the end of year near 31st March, some credit has come in the account as on the last date, say on 29th March, 30th March or 31st March. So that account is saved from becoming NPA because it does not fall in that 90-day norm now. Now, what does the RBI circular say about it? What is RBI now about it? What is the duty of auditor in this regard? Now, if there is one or two credit near the balance sheet date and the account has been regularized near the balance sheet date, then auditor has to adopt a cautious approach. Okay, and he has to see that credit which has come in the account is in fact genuine credit. The party has actually paid the money. It is not some kind of you can say window dressing. Say the some amount has been transferred from some other account, or some sort of accommodation entry has been made. So the auditor has to check these points, that if the account is regularized near the balance sheet date and there are only a few credits, then he should check about the genuineness of the credit. And if the credit does not appear to be genuine to him, or he feels that account shows inherent signs of weakness, then he should classify it as an NPA account. Okay. Second account is government guaranteed accounts. Now, government guaranteed account, it might happen so that government has given guarantee in some accounts. Okay, so you understand, when central government gives guarantee, it is a sort of sovereign guarantee. Okay, so in such a case, if guarantee is still there, if it is not repudiated, it is still there, then although account is not performing, special considerations would apply and the account would not be considered as an NPA. It would be classified as standard asset, although income would be recognized only on the recovery basis. Okay, so here there is a contradiction, that although the account would be recognized as a standard asset, but for income recognition purpose, it would be classified as NPA, and the income would be recognized on that basis. However, if the account is state government guaranteed account, then it would be classified as NPA if it is not performing as per RBI norms, and income recognition should also be on the basis of actual record of recovery, and any unrealized income will have to be reversed, and only that income would be booked which is realized. Okay, so state government guarantee has got no advantage as compared to central government guarantee. If central government guarantee is there, then the account, even if it is not performing, it would be classified as a standard asset, although for income recognition it would be classified as non-performing. Okay, so that is clear. Now we come to advances under consortium. Now, what is a consortium? Consortium account, students, consortium account means those accounts where two or more banks come together to lend to some borrower. Say, why two or more banks come together to lend a borrower, because the exposure might be huge, because one bank does not want to take a risk. So that is why two or more banks join together and they conduct joint appraisal and a joint sanction, okay, and joint monitoring of account is conducted. Okay, so the bank which is having major substantial share in the exposure, it is known as the lead bank, and other banks are known as member banks. Now, what are the NPA norms in relation to advances under consortium? Now, every bank has to ensure, say there are 5 member banks in the consortium. Now, every bank has to ensure that his share of recovery is coming to his bank. Say if all the recovery is being made in one bank, then other banks would have to classify that account as NPA in their books, although it might be standard asset in the books of main lender. Okay, so the member banks have to make sure that they should insist on getting their share of recovery from the borrower, from the main bank. Okay, so that is very important. That is very important to remember. Okay, because otherwise other member banks in whose books share of recovery is not coming, they would have to classify the account as NPA, and accordingly they would have to make provision in their books. Okay. Pooja, we are at point number 12, advances, and most likely we are at page number 12.28 and 12.29. Accounts regularized near balance sheet date, government guaranteed accounts, and advances under consortium. If you are searching your module, we are here. Okay. And one more thing in consortium accounts in relation to drawing power. Say we have understood that in consortium account, all the banks, all 4 or 5 banks which are part of the consortium, they come together and joint appraisal is done, and control of account is and monitoring of account is done jointly. So what happens in case of drawing power? So in such cases, the borrower is submitting stock statements to the lead bank. So whatever as per sanction, whatever is the share as per sanction of different banks, so the lead bank allocates drawing power to the member banks proportionately. Say the lead bank is having share of 2 crore and remaining 2 member banks have a share of 1 crore and 1 crore respectively. Total exposure, say assume, is 4 crore. So the lead bank would allocate drawing power of 50% to itself and 25% each to different member banks. Okay, so it is done. This is a mechanism keeping in view practical considerations. Okay, so the borrower is submitting stock statement at one place to lead bank, and the drawing power is allocated to the member banks. But as far as NPA is concerned, in case of advances under consortium, you have to remember that every member bank has to insist on its own share of recovery. If credits are not coming, if installments of member bank are not coming in its account, in its books of accounts, then they would have to classify that account as non-performing asset. Okay. So another point is accounts where there is erosion in value of security. Accounts where there is erosion in value of security. Now students, we have understood, I had told you that whenever an account is identified as non-performing asset, first of all, it goes to substandard asset category. For first 12 months, it remains in substandard, then it goes to doubtful and subclassified as D1, D2, D3. Depending upon the period, it remains as a doubtful asset. Now, there is a possibility that account straightway goes to doubtful asset or loss asset. Yes, the answer to this question is yes, it can happen. In what condition it can happen? It is discussed under this head, accounts where there is a erosion in value of security. What is erosion? Erosion means decline in value, gradual decline in value. So there are two conditions. Say if the bank has granted a loan to some party and at the time of granting loan, say value of security against which loan was granted, say was assessed by the valuer, and now the realizable value of that security is less than 50% of value that was put by the valuer. So what was the value put by the valuer at the time of sanction? At present, the present value of that security is less than 50%. Then in such a situation, the such NPA account may be straight away classified as into a doubtful category without first waiting for classifying it into substandard asset and then doubtful asset. In such a case, it would be straight away classified as doubtful asset. And second scenario is that if realizable value of security is less than 8%, is less than 10% of value assessed at the time of the sanction, then the account would be straight away classified as loss asset. यह कि मैंने जिस सिक्योरिटी के अगेंस्ट लोन लिया था तब उसकी वैल्यू 1 करोड़ थी, बैंक ने 1 करोड़ समझ के लोन दिया था और अब उसकी 10 लाख से भी कम है, तो इसका मतलब बैंक का पैसा डूब गया. Then that account would be straight away classified as loss asset. Okay, so is that clear to you guys? All these four things: accounts regularized near balance sheet date, government guaranteed accounts, advances under consortium, and accounts where there is erosion in value of security. Okay, and there is another. Now you would say, what about the advances granted against, say, fixed deposits or NSCs or KVPs? Can these be considered as NPA? These generally do not become NPA if sufficient margin is there. Say I am having fixed deposit of say 50 lakhs with bank, and I take a loan against fixed deposit of 40 lakhs. Okay, and say I do not pay interest on the loan against fixed deposit which I have taken. So the bank has fixed deposit my fixed deposit lying with is lying with the bank. So even if I do not pay, the bank would adjust the fixed deposit proceeds against my loan, because against 50 lakhs I have only taken 40 lakhs and 10 lakh is still the balance. Okay, so generally these accounts do not become NPA against securities, against fixed loans, against fixed deposits, loans against Kisan Vikas Patras, loan against NSCs. Okay, and then we would also be touching about agricultural advances. How, in what cases, in which cases agricultural advances become NPAs? What are the RBI norms regarding classification of agricultural advances as NPAs? So guys, as per RBI norms, as per RBI Master Circular on asset classification and income recognition, agriculture advances in this respect are categorized into two kinds. Now, agriculture advances for short duration crops and agriculture advances for long duration crops. Now, what are short duration crops and what are long duration crops? Short duration crops are those crops in which harvesting season is of less than 1 year, and long duration crops are crops which are having crop season of longer than 1 year. Okay, so what are short season crops? You can say like wheat, paddy, कि जितना time the time taken to sow the seeds and to harvest the crop is less than 1 year. Say like in case of wheat, the crop is say in case of paddy, the seeds are sown in the month of, the plants are sown in the month of June, July, and the crop is harvested in the month of October. So it is a short season crop. Similarly, in case of wheat, the sowing starts in the month of November, October, November, and the crops are harvested at around this time. It would be harvested in the month of April. Okay, by the end of March and the starting of April, near the festival of Baisakhi, these are harvested. So these are short duration crops, whereas sugarcane is a long duration crop. Okay, so what are the NPA norms relating to short duration crops and long duration crop? So a loan granted for a short duration crop is treated as NPA if installment of principal or interest remains overdue for 2 crop seasons. Okay, if installment or interest remains overdue for two crop seasons in case of short duration crop, then it becomes NPA. And in case of long duration crop, if the interest or principal remains overdue for 1 crop season, then it becomes NPA. So this much only you have to remember. Okay. Now computation of drawing power we have already done. I have already explained to you how drawing power is computed, what is its importance, okay, and what is its relevance in case of CC accounts, and why we are studying it, because it is important from the point of view of classification, because the account has to remain in CC account has to remain within the sanction limit and also within the drawing power. Okay, so guys, what should be the overall approach of the auditor? What should be the overall approach of the auditor as regard audit of advances? Now, for this, you have to understand how the process of granting of advances is carried out in banks. Say, if a company wants to take a loan from a bank, first it has to submit an application form. Then an appraisal of that application will be made by the branch of the bank. So what are the requirements? Why does the company need a loan? Say if it is a machinery loan, quotation would be called. How that machinery is related to the manufacturing of the company. What are the projections? What would be the future profits? Whether the company would be able to service its debts, whether the company would be able to service its interest in time. Okay, so all these things are considered. Besides, the bank also considers what the security company is offering. Now we had already discussed about primary security and collateral security. So bank would not be just satisfied with primary security. It would be also asking for collateral security, for having additional comfort that if something goes wrong and the borrower does not pay the money, then the bank has something to fall upon. And if the borrower does not pay the money, the bank can take possession of the collateral security and ultimately it will sell the collateral security and realize the money. Okay, so all these things, all these factors are considered by the bank before lending to a client. And the bank also, the concerned branch also takes into consideration the credit worthiness of the buyer. What is the track record of the buyer? Have they defaulted sometimes in the past? What is their CIBIL score? Okay, what is the CIBIL score of the promoters? Have they failed any time in past on their commitments? Is there something negative in their CIBIL score? These kind of things. And what are the bank also conducts discrete inquiries. On this basis, after carrying out this due diligence, the bank sanctions the loan. Okay, so now the sanction is made by the different levels of authority in the bank. Okay, so say the branch is headed by the chief manager, then it would be having one kind of delegation up to this much, say up to 2 crores of loan can be sanctioned by chief manager. Say if it is an AGM level branch, then the authority might be higher. Okay, so loans up to say 5 crores can be sanctioned by AGM. So if loans are to be sanctioned beyond say 5 crores, say then it might fall within the power of regional manager. Okay, or if it is beyond that in the power of chief regional manager, or so on. Or ultimately it may go to head office if the amount is very large. Then it might go to the board. Okay, so there are different levels of delegation of authority for sanctioning of advances. So when the loan is sanctioned, appropriate sanctioning authority sanctions the loan, and a proper sanction letter is issued to the borrower detailing out terms of sanction, detailing out terms that the borrower has to maintain financial discipline, that borrower would bring so much of capital, that borrower would be submitting stock statements at periodic intervals. Okay, so there are many such kind of things that borrower would maintain, would keep all its asset insured. Such kind of points are there in the sanction letter. So the borrowers have to adhere to these terms of sanction letter. So sanction letter becomes an important point for the auditors to see. Okay. So after sanction is given, then proper documents are executed in the bank. You understand that when bank gives the loan, it is not a sort of verbal arrangement. The bank gets signed from the borrower host of documents, including hypothecation agreement, say guarantee, and other kind of documents on proper stamp papers, which are required in accordance with the stamp duty prevailing in that state. Okay, so it is only after proper documentation is done that the money is released to the borrower. Even if you want to take a car loan, then also a number of documents are got signed from you. Okay, because it would not be possible for you to read all those documents, but many documents are signed by you. You have to sign at 25-30 places. Okay, so after release of money, then the bank continuously monitors the account. Okay, the bank continuously monitors the account. It sees that installments are coming on time, there are no overdues on the account, the interest is being serviced, and all the other terms of sanction are being adhered to. So all of these factors, right from appraisal, from documentation, to control, to monitoring of the account, these are all part of larger internal control system pertaining to advances, which has been designed and implemented by the bank's management. So the auditor takes a overview, what is the system, what is the procedure in the bank in relation to granting and sanctioning of advances, what are the levels of authority, and then he tries to obtain sufficient and appropriate audit evidence on the basis of above that advances have been sanctioned to borrowers in accordance with delegated powers of authority, whether proper documentation is made or not, whether proper supervision and is being carried out, whether accounts are closely monitored, whether there are overdues in the account, and if some promptive corrective action is taken. So it is only by understanding this whole system that auditor develops his overall audit approach in relation to advances. Okay. Okay, so while conducting audit of advances, the auditor would be concerned about so many things. First of all, auditor would be concerned that whatever the figure of advance have to be properly signed, stamped, and it has to be in accordance with the prescribed documentation norms of the bank. Okay. And another thing is that there should be no unrecorded advances. All advances, all loans which have been granted have been classified under the head advances. So because if some advances are omitted to be recorded under the head advances, then so the bank would not be making provisions, or it would not be making proper classification of these, because these have not been classified in advances itself, and the basis of valuation of advances is appropriate and according to the principles, and appropriate provisioning norms as prescribed by RBI have been followed. So all these things have to be considered by the auditor while formulating his approach in relation to advances. Okay, so guys, I have tried to make you aware of the broad areas of advances. As I have already told you, it is a very, very long topic, and uh, it requires deep understanding. But you have to only understand and remember what is there in your module for examination purpose. And I hope that I tried my best to convey to you in simple. It's over for today. Good night once again, guys. Very, very good night to all of you. Okay. Okay. Okay, guys. Hello, Sam. Hello. 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 Yeah, yes, yes.